Hi, good morning, everyone. Welcome to Phillip Securities Research Morning Call for the 7th of February 2022. Today, we have stock counter updates for Alphabet, Meta Platforms, Capitaland Integrated Commercial Trust, and Lendlease Global Commercial REIT. And on the macro and sector outlook, we have Singapore Weekly. I would like to pass on to Jonathan to get started.
Thanks, Ambrish. And good morning, everyone. So for today, I'll just start with Alphabet's fourth quarter and full year highlights. So I'll begin with the positives for their full year and fourth quarter earnings, which was put out last week. Revenue grew 32% year on year, supported by 31% growth in services and 45% growth in cloud. For the full year FY21, revenue was up 41% year on year, which is significantly more than Google's revenue 5 years CAGR revenue growth of 23%. So on to the next positive. Ad revenue is still an important driver for revenue growth. So Alphabet actually posted advertising revenue of $61 billion in the fourth quarter of last year, which represents a 33% year-on-year increase. This also represents about 81% of total revenue that is generated by the company. Much of this advertising revenue growth was supported by increasing advertiser spend, coupled with an uptick in consumer online activity over the holiday seasons. So what this means is that more and more people spend more and more time and money shopping online. And they also began to spend more of this time and money earlier on in the season, perhaps earlier on in the quarter rather than just in November and December. And obviously, most of the advertising spend mainly came from the retail segment, with finance, entertainment, and travel also strong contributors. So our next positive is that cloud continues to be Alphabet's fastest growing segment. It posted revenue growth of 45% year on year, with revenue of $5.5 billion and a significant $51 billion order backlog, which should provide Alphabet a stable source of cloud revenue moving forward. This just goes to show that there's quite a heavy demand for Google's or Alphabet's cloud services, and there's really not enough capacity to accommodate. And because of this, the company is actually continuing to invest heavily to increase the capacity of its servers and data centers to accommodate this demand. So we think that continued tailwinds from a global digitalization trends and an increased emphasis on cybersecurity should kind of help revenue growth moving forward. For our last positives, Alphabet actually mentioned that they were going to do a 20-for-1 stock split, which occur in the third quarter of this year. And this is for all its Class A, B, and C stocks. Of course, subject to shareholders' approval. So we believe that this could make the stock a little bit more attractive and accessible to retail traders and investors, because it will bring down the price from about $3,000 to $150 per share. So on an overall basis, the fourth quarter 2021 results were in line with our expectations, with full year FY21 revenue and PATMI at 102 and 103% of our full year forecast. On to the outlook, we forecast revenue growth for this coming year, FY22, at 18% year on year, which is a bit more in line with pre-pandemic growth rates, and slightly below its 5-year CAGR of 23%. PATMI is expected to grow 17% year on year, which is in line with revenue growth. We don't really foresee any more growth in net margins for this year, mainly because there was such a big jump from FY20 to FY21. But we still do expect this coming year to be a solid year for Google or Alphabet, as it continues to ride tailwinds from digitalization and shifting consumer preferences in almost all of its operating segments. So we upgrade to a buy rating with a higher target price of $3,493. Our previous target price was $3,380, and we raise and we raised FY22 revenue and PATMI by 3% and 1%. Our DCF target price is raised slightly, like I mentioned earlier, as we still do expect Alphabet to continue its dominance in digital advertising and other new economy markets. So that's all for Alphabet. I'll move on to Meta Platforms. And the title of this is Competition Knocks Growth and Raises Expenses, which we'll dive a little bit deeper on this slide. Generally, the fourth quarter earnings was actually quite decent, and full year earnings at the same time was pretty decent. Revenue grew 20% year on year for the quarter, and full year revenue grew 37% year on year. Just a little bit of comparison, their revenue 5-year CAGR revenue growth was 34%. So they actually beat their 5-year CAGR for FY21. This was mainly supported by a 9% year-on-year user growth and a 6% year-on-year increase in ad prices, and also a 13% year-on-year increase in ad impressions. So unfortunately, that was the only positive thing that came out of the call. On the negatives, Apple's iOS 14 privacy changes continues to affect Facebook's core advertising business, decreasing the accuracy of their targeted ads campaigns, and making it extremely difficult for the company to track and accurately measure the outcomes of these ad campaigns. So the iOS 14 privacy changes were basically a restriction on third-party data sharing. So Apple actually started allowing its users to decide whether or not they wanted to share their data to third-party apps like Facebook. And in some cases, I guess most of the Apple users decided not to share it because you can see that advertisers have actually begun reallocating their significant portions of their budget away from Meta and towards their competitors like Google and Amazon, which don't really rely that much on third-party data. So for Google, for example, most of their data is retrieved from their browser, and for Amazon, they have their own. They have enough data that they collect on their own platform. So they don't really. Their business model is slightly different from Facebook in terms of data collection. So we also see an increasing competition from TikTok and the emergence and growth in popularity of short-form video, particularly with younger users. So we can see that user growth is actually slowing down for Meta, with only a 0.3% quarter-on-quarter growth for fourth quarter of 2021. What's a little bit more concerning is that Facebook's daily active users actually shrank quarter-on-quarter for the first time by a really small margin, but it just goes to show that maybe Facebook as a platform is not as popular as it was previously. So because of this, Meta is actually scaling up hiring and investments to compete in short-form video, which to better serve their younger audiences. And this is actually leading to higher total expenses and is lowering their margins significantly by almost 10%, especially over the last quarter of 2021. So we also see the shift in this kind of format could be accompanied by near-term pressures on impression growth, as well as slower monetization rates, because historically speaking, video has been slower to monetize in terms of its ad revenue compared to just your static digital print ads. So lastly, Meta actually gave a really weak first quarter 2022 revenue guidance. It only guided to growth of about 3 to 11%, which is significantly less than other quarters. And this is mainly impacted by headwinds in ad impressions and prices. It does expect a full year FY22 total expenditure to rise at least 26%. And this comes on the back of increasing capex by at least 56% due to its scaling up of investments in tech talent and IT infrastructure. So moving to the results, Like I mentioned earlier, the fourth quarter earnings were actually in line with our expectations, with full year FY21 revenue and PATMI at 102 and 105% of our forecast. One of the reasons why the stock price dropped so much is not because of its actual performance, but mainly due to the outlook that the company gave during its earnings call, resulting in like a 25 to 26% post-market drop in stock price. So for the outlook, like I mentioned earlier, they guided to a weak first quarter 2022, and increased expenditure for the year. We expect this year to be a transition year for Meta, especially as it continues to battle headwinds from regulators and increased competition to maintain its leading position in the social media industry. We do maintain a buy rating with a lowered target price of $312 from $424 as we reduce the FY22 revenue by 5% to reflect growth headwinds, and a reduction in PATMI by 24% due to an expected increase in OPEX and CAPEX. Net margins are also reduced from 32% to 26% as a result. And our DCF target price is based on a weighted average cost of capital of 6.6% and growth of 3.5%. So that's all for Meta. I'll pass my time on to Natalie. Thank you.
Thank you, Jonathan. Good morning, everyone. I'll start off with Capitaland Integrated Commercial Trust full year results. Okay, so for the full year, the table on the left-hand side shows the summary of gross profit, NPI, distributable income, and DPU. However, do take note that these numbers, there's a very big spike in the numbers because of the merger between CMT and CCT, which was completed in October of 2020. So these numbers are a bit, there's a lot of noise in these numbers. So starting off with the revenue, revenue grew by 75% year on year. And okay, so this is largely due to the full year consolidation of two of these portfolios, as well as the consolidation of Raffles City, which used to be accounted for under the JV line, but it's now been brought to the top line and consolidated on a 100% basis. Okay, so then yeah, so the rest of the numbers, they are a bit messy, and the DPU growth is also not really very reflective. We move on to the positives. So for the positives, recovery in tenant sales, narrowing negative reversions, as well as and these two things point towards support. These two things point towards the improving tenant sentiment. So rental reversions narrowed to 7.3%, and this compares to first half reversions of negative 9.1%. In terms of downtown and suburban reversions, they were negative 2.4% and negative 13.8% respectively. In the full year, the total tenant sales also grew by about 12.2%. And this time around, the recovery in tenant sales is more broad-based, and 9 out of 15 of these trade sectors actually saw revenue growth. Tenant sale growth. Okay. In terms of rental waivers, note the support that the CICT needs to provide to its tenants has been greatly reduced. So FY21 rental waivers came in at $27 million. This compares to the $128 million that was dished out in FY20. On to the second positive, which is the valuation uplift of 3.5% year on year, or $752 million. So in terms of the retail portfolio, retail assets saw a modest 3% valuation uplift on the back of recovering performance, while cap rates remained unchanged. The office and integrated development assets accounted for 45% and 52% of the revaluation gains. So for the office, it's largely due to cap rate compression. I think it just reflects that the investors are still chasing after quality kind of stable assets. And in terms of the valuation uplift from the office side, and there was also the TOP of Capital Spring, which then there was a mark-to-market valuation from a previously cost of construction valuation. Okay, and in terms of there was also some valuation losses, but these were attributed to Clarke Quay and Raffles City. So these two assets, they will be undergoing AEI. So the valuation write down was mainly to factor in for capex provisions. Yeah. Okay, so now I'm moving on to the third positive. That would be the portfolio reconstitution and entry into a new market. Next slide, please. So this table on the top left-hand side actually summarizes the portfolio reconstitution that has taken place in FY21. So there were three of them. First of all was the divestment of 1 George Street at a very tight yield of 3.17%. And then also then comes the entry into Australia, Sydney, Australia, through three assets, two office assets, which is 66 Goulburn Street, as well as 100 Arthur Street. And then finally, 50% stake in an integrated development located at 101 to 103 Miller Street. Yeah, so all these three acquisitions, they were reinvested at a higher yield of 5.1%. And also just crossed into a new financial year. CICT also announced the divestment of JQ at very attractive cap rates of 4%. Yeah. Okay. In terms of the negatives, portfolio occupancy was down by 2.5 percentage points year on year. So total portfolio occupancy was 93.9%. And this was lower because of both the retail as well as the office assets. So for retail occupancy, it was down by 1.2 percentage points. And most of the downtown malls actually registered a decline between 1.1% to 4%, with the exception of one asset, which is Bugis Junction, which saw a slight 0.4 percentage point improvement. Meanwhile, for the suburban malls, most of the malls actually recorded slight occupancy improvements, and occupancy is currently back at pre-pandemic levels. In terms of Clarke Quay, so Clarke Quay is a very special asset. As we know, there's a large proportion of entertainment as well as nightlife tenants that are located at Clarke Quay. So due to the continued restrictions that surrounding these trade sectors, Clarke Quay suffered an occupancy decline of 16 percentage points. So occupancy is now 73.5%. And this asset will be undergoing AEI once the necessary regulatory approvals have been obtained. So the office portfolio, occupancy dropped by 3.6 percentage points year on year, and the office occupancy of 91.5%, it is below, or it lacks the CBD core average occupancy of 93.3%. And this was largely attributed to timing of lease renewals. So by the time, as of 31st December, there were some leases that were in advanced negotiation that did not materialize in that financial year. So both of the two assets which have lower occupancies were Capital Tower as well as 6 Battery Road. So Capital Tower, the management is still in advanced negotiation with a tenant for the space vacated by JP Morgan. So just as a refresher, JP Morgan has actually moved from Capital Tower to the new development, which is Capital Spring, hence leaving behind a vacant space. The manager is in advanced negotiations with a new tenant for the space, and if it is successfully leased, it will bring occupancy from 76.8% to 94%. Okay, another asset will be 6 Battery Road. So 6 Battery Road, the manager is also in advanced negotiations for a space that was downsized by Standard Chartered. So and just in January, after the end of financial year, the manager has successfully leased this space out to another tenant, and the occupancy will be 90%. For the new development, Capital Spring, which achieved its TOP in November of 2021, occupancy was 91.5%, and this, of course, was a stark improvement from the previous quarter, which was 83.1%. And presently, as we speak, another 5% of NLA is in advanced stages of negotiation. On to the outlook. There's obvious benefit from the further relaxation of dine-in group size, as well as return to office, and this should help to lift tenant sales, especially in the downtown malls. There's also a possible valuation write-back for retail assets, which are still 1.6% to 3.5% below 2019 valuations. And in terms of, further or future portfolio reconstitution, these efforts will likely be focused in Singapore. So in our view, Ion Orchard is a low-hanging fruit, as this mall is matured and has been operating since 2009. Yeah. So the rest of the assets that could potentially form CICT's pipeline are 79 Robinson Road, Jewel, as well as the remaining stake in Capital Spring. However, of course, all these assets are still relatively new and have not reached stabilization. But they of course are potential pipeline assets in the midterm. So the full year earnings and DPU, they were actually in line and they formed 102% of our forecast. We lower our FY22 to FY26 DPUs slightly by 5.2% to 6.7%. This is mainly to factor in the higher cost of borrowing that is expected to materialize in 2022 and 2023, as well as higher utility and energy costs. Okay. Our DDM target price is lowered slightly from $2.54 to $2.39. Okay, so that's all for CICT. We'll now move on to the next counter, which is Lendlease Global Commercial REIT. Okay, so this is Lendlease first half 2022 results for the period ended December 31st. Okay, starting off with the results at a glance on the left-hand side. Gross revenue fell by 6%, and this was due to negative reversions at 313 at Somerset, as well as lower revenue from Sky Complex, which is Lendlease's Italian asset, and this was due to depreciation of Singapore dollar against the euro. Okay, in terms of NPI, it fell by a smaller percentage compared to gross revenue, and this was due to lower property expenses. Yeah, from the absence of doubtful debt provisions, lower marketing, insurance, and salary expenses. In terms of distributable income, it grew by 3.8%, and this was due to the additional stake of GEM that was acquired over the period of August to September 2021. So this, of course, brings L-REIT's stake in GEM from 3.75% to 31.85%. And the amount, there's a small breakdown here to show the contribution from the associate, the changes year on year. Overall DPU grew by 2.6%, and this DPU of 2.4 cents was in line, forming 48% of our full year forecast. Onto the positives. So on the positive side, we saw higher occupancy, positive reversions, and unlocking of GFA at Somerset 313. So occupancy for the mall is 99.7%, and this is an all-time high for 313 at Somerset. So this was about 1 percentage point higher year on year. Approximately 20,000 square feet of NLA, or 17% of GRI, was signed in the first half of 2022, and this reduced the FY22 expiries from 24% to 7%. So these leases signed in the first half yielded positive high single-digit reversions, which is a sharp reversal from the negative double-digit reversions seen in FY21. In terms of the utilization of 660 square feet of space, so this is due to an increase in the permissible plot ratio from 4.9 times to 5.6 times. This actually resulted in additional GFA of 11,000 square feet. However, of course, Lendlease only unlocked about 660 square feet in this first half, with plans to unlock the remainder gradually as the leases expire. Yeah. So basically, I'll talk a little bit about that later. And another positive would be the robust portfolio metrics. So interest coverage ratio, it actually improved from 8.8 times to 9.7 times. And in terms of adjusted ICR, which factors in the payment for perpetual holders, that stands at 5 times. Cost of borrowing is maintained at 0.92%. Okay. There was also, the manager also shared with us that there has been an improvement in rent in arrears, and the rent in arrears is even better than what it was pre-pandemic. So it's an improvement, and they credit this improvement to the rebalancing of tenant mix done in earlier quarters in favor of tenants that are actually trading better and have stronger cash flows. In terms of negative, first half revenue was dragged down by lower GRI and negative reversions, as well as a lower GTO component from 313 at Somerset. Okay, so so the negative reversions are, it was inevitable because of the weaker or softer market that we saw in 2020 as well as 2021. So that led to negative reversions, but we believe that Lendlease strategy to prioritize occupancy and refresh 313's tenant mix has actually paid off. And by prioritizing the occupancy, they actually managed to lift the vibrancy and positioning of 313 as a lifestyle and shopping destination. And this actually put them in a good position and price for pricing power, to command these positive reversions that we saw in the first half. Overall, tenant sales for the first half of the year, that means from July to December, was actually lower year on year. It was lower by about 9.2%. And this was due to the restrictions, in the transition phase, stabilization phase that happened in 2021. Yeah, and that led to a 30% decline in GTO. But overall, GTO is still a very small portion of the total revenue. It's about 2%. Okay. In terms of outlook, the additional, the GFA uplift that results in 11,000 square feet of space that can be utilized. After utilizing the 660 square feet, there's still about 10,000 square feet remaining, and they will be deployed as and when new renewals or changes in tenant mix happens. This is to minimize the impact of AEI works on mall vibrancy as well as the recovery of tenant operations. Yeah. And Lendlease will try to deploy this additional space towards prime locations located on the lower floors. Okay. And once fully deployed, the additional GFA could increase NPI by 2 to 3%. Also, on the cards for Lendlease is the potential, acquisition of the remainder stake in GEM, and that could potentially happen over the next 12 months. So the manager is still in discussions with the remaining investors of the funds that hold the asset GEM. Okay. In terms of our recommendation, we maintain and accumulate with a DDM target price of 94 cents. This is slightly lower compared to our previous target price of 97 cents. We lower our FY22 to FY26 DPUs by about 1.4% to 1.9% on the rising cost of borrowing. And our cost of equity is actually raised very slightly from 7.66% to 7.72%. Yeah. So that is all for me. I'll now hand the time over to Paul.
Thanks, Natalie. Next slide. Next. Sure, is there a lag on my side? Yeah.
Or is it the tactical views page really?
Oh, okay. Yeah. So sorry. In terms of some of the key macro news that came out for Singapore, we had the PMI number for January. Basically, what it means is that manufacturing activity in Singapore is basically stable. It was 50.6. They're relatively unchanged to the last month and even to the year ago. So manufacturing activity is stable growth because it's still above 50. We had some retail spending numbers, which is retail spending in Singapore is very vibrant. It's up about 9%, higher than the prior month's 5%. Just to give you some context, pre-pandemic retail spending in Singapore is probably 1% at most 2%. So this is way above trend compared to the pre-pandemic levels. Supermarket sales remain resilient. It's still growing despite the higher base. What was doing well in retail spend in Singapore, at least for December, which is festive period. It was a lot of discretionary spending. You can see from there like watches, even apparels. Healthcare numbers for Singapore were not that good. I think December was down about 16%. Fourth quarter is down 19%. Sorry, it's not a typo there. Dental is reverting back to pre-pandemic levels, so it's still stable, down about 2%. The big number from the US was the payroll numbers. It was a huge jump, about almost 500,000 compared to the expectations of 125. I think the bigger news was the prior month, which was in December, which was initially a disappointing number, about 200,000. Then the authorities kind of revised the additions to payrolls. So the actual number now is 500,000. So it's double what were the expectations. So in conclusion, the job market is very strong in the US, despite Omicron. But one of the reasons is when we were looking at some of the data points, if you look at the savings rate in the US, it was initially spiked up during the pandemic due to the fiscal spend, but now it's collapsed back to pre-pandemic levels. So one potential reason is because the saving levels is kind of depleted back to pre-pandemic, and perhaps the workforce now have to return to have to look for jobs as their saving levels have kind of depleted. We normally don't look at Europe, but there was a big news in Europe, especially on inflation. So for the Eurozone, CPI or inflation in January was 5%. This is a record high since the formation of the EU. And as a result, during the briefing, I think the ECB was a bit nervous on what they could say, because obviously there's a lot of pressure for them to raise rates. So they just reiterated that they have like three very vague criteria, and I think very subjective criteria, which kind of, you must read inflation target, the durability inflation, and also underlying inflation. But ultimately, there's a lot of pressure for ECB, for ECB to raise rates. So the swap markets are pricing in about a 2 rate hike in the US. So in conclusion, for the tactical views, what it does mean is that there's a synchronized global tightening, not just in US, but even in Europe. So globally, rates are all rising, and it will add pressure to global growth with a lag. One potential beneficiary are actually the European REITs. They benefit in two ways. Firstly, the stronger euro against the Sing dollar, and also a lot of the rents is actually linked to CPI. And because we're getting like record high CPI, so they can get this nice kind of headwind in terms of the rental reversions. In terms of some of the key events for this week, the big one will be inflation out of the US. The market is expecting around 7%, but if you get any huge number, then there will be probably some sell down in the US market. If inflation numbers are way above 7, what it means is that the Federal Reserve may have to tighten even more than expected, possibly even a 50 basis point hike in March, considering that the employment market is so strong and also inflation is running far ahead of expectations. So Thursday is a big number in terms of inflation. We have some of the webinars. For this week, we have Lendlease, which I think Natalie just briefed. But I guess, like we mentioned in the earlier briefing, I think the question everyone will be asking is, with rising rates, why should we buy a REIT? So I guess this will be a good platform to kind of ask the CEO directly. I mean, like, why should I buy you now that interest rates are rising? Yeah. Next slide. Okay, sorry, there's a lag on my side.
The slide is ready, Paul.
Oh, okay. I don't really see it. Okay, but okay, I see it now. Sorry for that. In terms, we have our usual barometer of COVID cases. I think the one to worry is the red line. I think mortality continues to climb up. Yeah. Although in Europe, we all know that they are reducing more of the lockdowns. They're easing even further despite the elevated cases. Next slide. Okay, I don't see it, but I guess it's the Singapore slide. I think for the Singapore slides, more worrying is the level of hospitalization. So I think that will be the issue. I mean, if the authorities were to try to relax further, the worry is the level of hospitalization coming out from Singapore. Okay, next slide, which is the red line. Next slide. Yeah. Yeah, sorry, there's a major lag on my side. Okay, in terms of the retail sales, this is just an illustration. You can see the vibrancy of retail sales in the third and fourth quarter. Like in the third quarter is 4% and 8%, and even though even for supermarket is 6%, so Sheng Siang should kind of announce some nice numbers considering that they tend to grow faster than market. Next slide. Okay, the next slide is basically just on the healthcare numbers. So I guess this is more the left side, the left picture is more of the private hospital admissions. I guess this is more a Raffles Medical slide. We just wanted to show you that pre-pandemic to now, there's almost a 18% decline. These are all mainly due to the lack of medical tourists, but they should still report some good numbers because of all the government spending on COVID testing and vaccination. The table on the right, because we cover Q&M, is just to have a barometer of the outpatient attendances at dental clinics. So we can see that it's reverting back to pre-pandemic levels. But for Q&M, we expect them to grow faster because of their 20% growth in dental clinics. The next slide. Yeah, so I don't see the slide. It's always a lag.
The slide is ready.
Yeah, okay. In terms of this is just a chart on ECB. If you focus on the blue line, this is the level of inflation in Europe. So you can see that it's at all-time high. The red line, ECB has basically three types of interest rates, but this is the one that I guess everyone kind of focus on. This is the deposit rate, which is a negative number. So you can see the big discrepancy between the red and the blue line. What it means that ECB needs to raise rates. So there's also pressure for Europe to finally raise rates. The table on the right is just how does gold price move compared to the amount of negative bonds out there. So you can see there's a relatively close correlation between the amount of negative bonds and gold. I mean, the logic there is that if I'm going to get negative yield in bonds, I might as well just buy gold. It's like a zero coupon bond. So you can see that now that the amount of negative bonds might eventually disappear globally. You can see from the blue line. Of course, the risk is that gold prices may collapse down to those levels, but the thing that may support gold is just the amount of liquidity. Because if bond prices are going to enter a bear market, then one place to hide out could be gold. Again, this is just out of interest and just to show for everyone. Next slide. Sorry, I'm not sure why there's such a big lag on my side.
The slide is ready.
Oh, okay. I can't see actually. Oh goodness, it can't appear on my slide. Okay. Oh, okay. This is our model portfolio. Our model portfolio called Absolute 10. So this refers to our January 22nd performance. The 10 stocks are on the table on the left. So you can see that what hit our model portfolio were all the mid-cap names, like Del Monte, even HLNet, even though there's been no change in fundamentals, but there's been the major sell down in January. What has helped is mainly the large caps. So as a result, we were kind of flat in January compared to the STI that was up 4%. Next slide. Yeah, let me just try to run this faster since it keeps on maybe. Okay, I think this slide should be on the amount on the movers for. Oh, sorry, you're going backwards. Yeah. Okay, the next slide should be the January 22nd performance. the table on the left refers to sector performance. So the best performing sector in January was the finance sector. Are we on that slide, Ambrish?
Yes, Paul.
Oh, okay, I can't see. Okay. But anyway, the best performing sector was on the finance sector, mainly because of the banks. The worst were actually the REITs, narrowing down to the industrial REITs. Those stocks that you see on the right-hand side is basically the performance. So the top 10 gainers were generally Sembcorp Industries. I think one of the reasons is because they secured long-term PPAs for their Indian plants. And then if you scroll down, it's basically all the banks did well, UOB, 11, OCBC, DBS. Then on the right will be all the top 10 losers in January. These were mainly all the tech names, all the semiconductor names, Nano, UMS, Franken. So these were all that were sold down, including some of the REITs that were also weak. The bottom is just for reference. What were the stocks that pulled the STI up and what pulled the STI down? Again, it was the banks and the large caps. The losers were mainly on the REITs. So a lot of the REITs that were on the STI that actually put down the STI. The next slide. Okay, can we see the next slide? Okay, I'll just go through the next slide. The next slide refers to the asset class performance. So the one on the left is STI. So the worst performers were actually the Singapore REITs that were down around 7%. We are measuring it in US dollar terms, just to get a better comparable. The other segment that didn't do well, of course, was the US names, which US S&P down 5%, and also the bonds ETF also down. The best performers were actually in red, which is 2022, which is in red. January 22, commodities continue to do well, and the STI also continue to do well. Okay, next slide. Ambrish, is the next slide on S-REIT? Sorry, I can't see.
Yes.
Okay. Okay, let me just run through this because I can't see, but I have the slide from me. So this basically, I know we got a lot of questions on STI, how are they performing during rising rates? So the orange lines are basically the Fed fund rate, and the red line is actually the Singapore government bonds, and the blue line is the S-REIT index. So from this chart, you can notice that movement in the Fed funds rate doesn't really impact the blue line. What really impacts it is movements in the red line, which is the Singapore 10-year government bonds. So whenever we have a rising interest rates, you can see the blue line actually does react. You can see that the REITs do fall during rising interest rates. Again, it is intuitive, but again, we're just showing you in chart form. So you can see whenever the red line kind of spikes up quite significantly, which is the government bonds, you can see the blue line actually collapse, especially, I guess it's more clear in the 2014. You can also see it in 2016. You also see it in 2017. So the non-shaded lines are basically when which is when interest rates don't rise, and that's when the REITs actually do rally. You can see that when we don't shade it, that's when interest rates are actually coming down. That's when the bonds actually, when the blue line rises, and that's when the REITs actually perform well. Again, this is clearly everyone kind of knows this, but just to show you in a chart form for everyone's benefit. The next slide, if you move on to the next slide, as usual, we always got requests of what are some of the major results coming up. So for this week, we're going to have a few REITs. In yellow will be those names that we cover, Ascendas, Manulife. Next week will be the big week, because next week will be all the banks will be coming out. So you will have the DBS and also UOB. The stocks we cover will be DBS, UOB, and also even Prime US REIT. Okay, I think this is the end of it. Sorry for the lag. Apologies for that. I'm not sure why. It's probably on my side. I think we can go to Q&A now. Natalie, you want to go ahead first? Then go to Glenn.
Okay, sure. The first question I see would be the question on Lendlease. If Lendlease were to acquire the remaining stake in GEM within the next 12 months, would there likely be fundraising exercise required? Okay, so for the remaining stake in GEM, it is valued at $1.4 billion. And usually it's acquired based on NAV. That being said, the manager is open to various funding methods, such as sustainability loan placements, preferential offering, or even increasing their gearing, which is currently relatively low, around 33.5%. So with this gearing, to bring it to a 50%, there is still a headroom of 150 million. Of course, this acquisition could be done in stages, but overall, yes, I think there will be some fundraising required. Next question would be comments on Mapletree Industrial price. The price keeps falling. Okay, so overall for Mapletree Industrial, I think first of all, the industrials are impacted by the interest rates, or rather the expectation that interest rates will rise in 2022. And so that is one side of things that impact all the REITs. So since the 1st of January, REITs have been down between about 3 to 10% due to this expectation of rising interest rate in 2022. Another reason for the industrials performing poorly is because of they recall that they were actually one of the early recoverers. Sorry, let me correct my English. They were one of the there was an early share price recovery for the industrial REITs. That of course meant that the industrial REITs were trading anywhere between pre-pandemic levels or even 5% above pre-pandemic levels. So as we move into this new phase of reopening, recovery, endemic phase, and pushing through with the reopening, there could have been some rebalancing from these more defensive kind of counters to more reopening plays. Yeah, so I think that's another one of the reasons. Yeah. Okay. When do you think the rate increase impact show in REIT markets? I think it's already showing, especially more so since the start of the year. I mean, even there was a bit of a share price weakness in 2021, of course, due to the uncertainty of the reopening that has weighed on three sectors, namely the retail, office, and the hospitality. But more so the impact from the interest rate. We're already starting to feel it. The REITs have, like I mentioned, that the REITs are down between 3 to 10%. Since the start of the year. Yeah, and this is largely due to the expectation of interest rate appreciation. Okay, I think that's all for me.
Okay, thanks, Natalie. I'll take the one question about why is SGX going up. So just a quick run through for their profits and revenues. So their revenues were actually flat, so there was not much difference. However, their profits were down. Their net profit was down about 9% year on year. So it looks rather bleak, but there are a few positives that we can look at. Firstly, the first positive would be that their acquisitions, which is the BitFX as well as the, give me a minute, I can try to find it. Yeah, the BitFX and Scientific Beta, the revenues were actually up 20% year on year. And this is something that will be gaining scale, and they're saying that this will continue to grow. And secondly, the biggest concern that we had was that their A50 index would be there'll be major competition from the Hong Kong Stock Exchange's one. However, it actually expanded by 10% between October and December. So that is quite good. It's showing that the pie is actually growing. So it's not like what they mentioned was that the pie is growing and their share is also growing. So although Hong Kong Exchange has released this, there are more people going into this the A50. So they're not losing out. And I would say it's a win-win situation for both SGX as well as Hong Kong Exchanges. It is just growing overall. And I would say the third one would be their float. So they are also a recipient from the rising interest rates. And I'm looking at the full year results because they have actually released more details during the full year results. And the full year results, they have a 12 billion float from collateral. So They also reported interest income of 72 million, and this represents about 13% of the operating profit. This is very low because of the low interest rates. So we have done our calculations and we have seen that there's a interest rate sensitivity of 25 basis points would mean an increase of 30 million in the operating profit. So with a rising rates, we can expect that, but not by just doing nothing, this 30 million will increase with every 25 basis points of a rate hike. Yeah, so I think that is the three main reasons why I think SGX price is going up. Okay, I think that's all I have for SGX.
Okay, let me try to answer some questions. There's quite a number of spec questions, so let me try my best. Hi, Paul. Is the recent weakness in share price of Pegasus spec presenting a good opportunity to buy? Since there's nothing to lose as the buyer, be able to get back $5, but on the other hand, there could be upside if a good merger. Yeah, we at these levels, you can think of it like within 2 years, most likely going to be less than 2 years, because they probably have to propose something less than 2 years, not until the very end of 2 years. So maybe within 1.5 years, you will get back your $5. And not only that, because now they are trading as a unit, I think in the spec there's a U there. So basically what it means that you also get free warrants after 45 days. I think should be early March. So now are you only getting your $5 back, you're also getting some free warrants. So in a way, the irony is that you are getting the money that other people put in if you're buying below $5. So we still we think at below $5 it is definitely, we think it's a good buy at these levels, because you're getting your money back and you're also getting warrants. Once they break up into a share and warrant, then it's a bit more challenging. Because then the other party will have free warrants, then then that would be a bit more challenging. I think right now, before this split, I think anything if it's below $5, I think there's value for investor. Because it won't be 2 years. I think probably 1.5 years, they have to try and seal a deal. Or even within 1 year, they will try to seal a deal. And you can just vote, or you can actually vote or go for the deal, but give me back my money. So, which is a bit weird for these specs, but this is how it actually works. Yeah. I hope that helps. The hyper, what's your view on SGX specs all drop below IPO and bearish? Yeah. So like you mentioned, I think there's upside to this. You are guaranteed that $5, because whatever $5 is all parked in the escrow account, which can only be returned once they make the acquisition, or you vote to get your money back, or once they go for the EGM. So we think there's good value here. And like all the specs, even in the US, they typically don't trade much until there's a news flow that there's some rumor of some acquisition, or maybe one championship. Also, I mean, there's a rumor, it could be one championship, or I'm not sure who's buying it, but if there's news that maybe one championship, then that could create some speculative demand. Obviously, they are below 5 right now because of the negative sentiment over any tech stocks has been hurt. So maybe that's one of the reasons why. But below 5, I think there's a good value here, because you're getting your $5 and there's free warrant. Yeah, sorry, I keep repeating the same thing to the same question. Yeah, thanks for your question. Happy New Year. What should retail investors be looking at in the coming Fed budget? What is in your wish list? I mean, our wish list is to spend more, but unlikely the authorities, after spending so much for the last 2 years, it's more like the bill is coming, which is GST. So I don't think there could be much coming up. It's more like maybe GST, and then they probably give some vouchers to some of those most affected. Yeah, we're not expecting much. Yeah, it's more like after they give us such a nice treat the last 2 years, the bill is probably coming in this budget. Yeah, and usually budgets don't really move. Even the last 2 budgets, there was it benefited maybe a little bit to Sing Song. So really, usually budgets don't really move the market much, unless they cut corporate tax, which is not going to happen. Apart from that, we don't really see much. Yeah, I hope that helps. I mean, this is just my own view. Paul, with S3 not performing and the 3 banks run out, what other sectors should one look up? I think for us, we like some of the mid-caps names that we like. of course, what has done well is the restructuring stocks. If you follow our model portfolio, our stock picks are going to gravitate towards those model portfolio stocks. So we like stocks like HRNet. We think the results should be strong considering the employment picture. We also like Del Monte and also like Capital Corp. But these are we will probably stick to those names that are in our model portfolio. Like maybe Natalie mentioned earlier, anything that looks like a bond, sounds like a bond is going to be hurt. So even Netlink Trust, those that pay very stable 5% yield, I think those are going to get hurt because if investors see that you look like a bond and there's no growth in your DPU, or then you might get hurt. But we stick to those. Even semiconductor, we think can still do well, especially when the results are coming out. If you look at stocks like UMS and AEM, most of their customers are announcing very aggressive budgets. Even when you like Applied Materials, Intel, they're all announcing aggressive budgets. Even Facebook is announcing very aggressive capex spend, like what Jonathan mentioned. So this will be beneficial for the whole semiconductor because they're going to invest a lot on cloud infrastructure. So we think that would still do well for the next 6 months. Yeah, maybe second half might a bit look more stretched, but I think for the first half it still looks strong. Okay. Okay, I will try this. Comments on GK Gold investment in Opal Healthcare, please. How does the regulatory changes affect the net profit? Okay, I really don't cover. I'm just reading through the results. So Opal Healthcare is like aged care in Australia, but Australia is a bit very unique. Their previous regime was they will issue license. Like that means there's only a limited pool of beds, and of course limited pool. Then everyone just have to go. It's like a captive market. But what they've done is they change it. So they give the seniors money to decide which aged care. So as a result, it's going to open up a lot of competition, my guess. So what has happened is that GK Gold had to do a major write-down. They made some acquisitions through this entity called Opal Healthcare, which is listed, I think. And they had to make some goodwill because the licenses are no longer valid. The licenses in accounting terms were considered indefinite. So it's like a freehold, property, and then the freehold property now come to only 2-year lease. So as a result, they had to make a huge write-off, and it took up like 30% of GK Gold's book value. So now GK Gold, after this, the book value will probably be like $1. Yeah, and they're going to have like almost 100 million of goodwill amortization. That means every year they're going to have to amortize for until 2024. Yeah. I hope that helps because I don't really cover, but I'm just reading through the announcement when I saw the result. Yeah, that's basically what happened. I think the next two is Natalie. Then I think sorry, because Viren is no longer with us, regretfully, so we can't take on any of the technical analysis questions for now until we find someone else. Yeah, apologies for that. Natalie, do you want to take on the last two before we kind of end it?
Sorry, I forgot to unmute. So do you expect S-REITs to fall further should the Fed actually start raising rates in March 2022? Currently, I think the REIT market's already reacting in response to this interest rate, or rather rising, anticipated rising of interest rate. So I think whether or not the REITs continue to fall, it really depends on the number of rate hikes that we see. So this, I could say no, but then if let's say at the end of the year there's actually like four or five rate hikes, then definitely there will be some more correction. Yeah. So this is actually you have to see how the market, or rather how the Fed rates, the number of Fed rate hikes and the quantum as well. Yeah. What is the outlook for Capitaland investment? So Capitaland has not yet announced their results for the full year. It should be coming, I think, maybe in the next 2 to 3 weeks. Overall, the news that has been coming out from Capitaland is that they have managed to sign another year of another all-time high of service residences under the Escort Limited arm. Apart from that, apart from that, there isn't really much of an update. But safe to say that because they are still shareholders of some of the REITs. For example, your Escort. Yeah, and so therefore there will, and Ascenders, of course. So there will be a bit of a recovery in earnings coming from their stake in these investments. Yeah. Whether or not divestments is in the card, we do hope so, especially for their stake in in the US multifamily assets that could potentially be sold to Escort Residence Trust, as well as Ion Orchard that could potentially be sold to CICT. So of course, all of these would then help with capital recycling for Capitaland Limited. Yeah. Okay, so I think that's about it.
Let me just add for the REITs, you have two big challenges because the rate hikes is not just this year. So maybe you got 5 hikes this year, but what if next year you got another 4? So the headwinds for REITs is not just this year. It's going to last for, I don't know, it could be even 1.5 years. And that's number one. Number two, it will be more challenging for those S-REITs that depend a lot on acquisition growth. Right, Natalie? I think probably Capital DC stands out. The problem for Capital DC, I mean, again, this is my view, nobody asking him anyway. It's one of those very few companies where their growth is very dependent on the share price. You look at Venture, the share price dropped 20%, not going to affect the business. Maybe some employees are not happy because of the share option. But if the share price drops really badly for Capital, then Capital DC, the ability to make acquisition is going to impair them. Then the market might start to derate even more and derate even more. So those are the REITs that are a bit more worrying. I do not know who they are. I can only think of Capital DC. But I think Natalie can. So it's not just the headwind from interest rates. It's also the share price might impair their ability to acquire, and that will kind of affect their growth, their ability to grow. Yeah, because they can't make any accretive acquisitions. So these are the two additional headwinds you're going to get for the REITs. Before I hand it over to Natalie, let me just answer this one first. Any comments on Silver Lake? We kind of like this stock because after there's going to be a bit of pent-up investments by the banks. I think when we meet them, one of the things we're going to ask is also, like UOB acquiring Citibank. This could also mean additional business for them, or even, I'm not sure DBS is a big client, but for UOB, we think is one of their clients. So when you have an acquisition, you probably need to integrate the system of Citibank. So this will be the additional business for Silver Lake. So Silver Lake should benefit because after the 2020 lull, when all the banks are so careful, they do not want to spend anything, you're going to get this big investment wave by the banks, and then you made worse by all these digital banks coming. So I think we're kind of positive on Silver Lake. Yeah. Anyway, I hand it over to you, Natalie.
I'll just touch on the last point that Paul made about the REITs being affected by their share prices. This is actually true because, as we know, Singapore REITs is more of like a dividend play, and the payout ratio is always above 90%, 90 to even 100% payout. So that just means that every time there's only a certain amount that you can unlock from a portfolio through AEIs. You cannot be doing AEIs on the same building over and over again, expecting to reap some uplift. So at some point in time, there will be a need to grow via acquisition or inorganically, and then that comes the problem because unlike the US REITs where their payout ratio is actually not up to 90%, so they are still able to sort of grow this the cash in their piggy bank. Versus Singapore REITs where the payout ratio is very high, so the ability to save up some funds for reinvestment is a bit challenging. But of course, another thing that the REITs can do is they can start to opportunistically divest some of their assets at higher yields. We're already seeing that office cap rates have compressed, so this could present a good opportunity for divestment of some assets, and then reinvesting it in other growth markets. Yeah. So So today's example was Capitaland Integrated Commercial Trust, where they divested some of the Singapore assets at low cap rates of 3 to 4%, but they are reinvesting at higher cap rates of 5%. Yeah.
Okay, I think, yeah, because some questions on apologies. These companies we are not very familiar. We probably can't comment on them. But when they do have an analyst briefing, we will definitely kind of update everyone. Some of these names like Yang Zhejiang, Bukit Sembawang is like it's it's like a movie star that never appears. You never see them in any movie. There'll be no interviews or anything, so you hardly get to meet them. Yan Lot, if there's any briefing, we will definitely try and brief everyone. So apologies, we probably can't help you on this these two stocks. Nettie, I think you got one more for maybe the sensitivity. I think this is on REITs from rising rates.
No, I think this is what US for the United States to service its debt if the rates keep rising. Oh, I think it's more macro.
Okay, sorry, I don't have the exact data, I think, but if you look at some of the US stocks, like the FANG stocks, they have virtually no debt. Yeah, so I don't have it right now. I need to pull out some stats. Yeah, sorry, I don't have the exact answer. Probably take me like 15 minutes to go and check this number out because they got this debt service ratio. I don't have it. Yeah, so sorry for that. I can't really answer that. How will it be more costly to service the debt? Yeah, apologies. Let's take this last one. Any thoughts on Singapore tech stocks like EM, Franken, UMS? I think they will still do. They will, like we mentioned earlier. We think they will still do well. Firstly, you're going to get a nice fourth quarter results to kind of have gained some momentum, and all their customers are still on the announcing aggressive capex. When I say their customers, I'm referring to like TSMC, Intel, all the foundry companies. They're all announcing aggressive capex. So this, and the good thing about AM, UMS, these are very front-end equipment based. Yeah. So only the contract manufacturers this time around are suffering, like Venture, because of the supply constraints. So maybe the handover for tech stocks from semicon to contract manufacturers might happen maybe only in the later part of this year. But right now, the semiconductor stocks are still doing well. Yeah, I hope that helps. Yeah. Okay. Natalie, you know much about Hong Kong land? Yeah. Not sure. Yeah. Okay.
Yeah,
The one was.
I can help with this question. Yeah.
Yeah. Okay. The interest rates was regarding the U.S. government. I don't have the exact stats, but I know the Federal Reserve owns maybe. I don't have the precise number, but from recollection, maybe 20-30% of all the U.S. treasuries. So in the end, they're just paying the interest back to themselves. Yeah. And the good thing about being a US debt issuer is that, this is your own currency. So you're just issuing more money. It's not like Malaysia trying to issue US dollar to government bonds where nobody wants to buy. So this one is like, it's like Malaysia issuing their own ringgit bonds. You can issue it to perpetuity. So I don't think that will be a major hit to them, their ability to issue debt. But it will be a fiscal drag. Because last year there was such a huge fiscal spending. So this year, without the fiscal spending, you will see US household incomes and their savings rate starting to collapse quite dramatically. I think maybe next week we'll just show you a chart. So growth in the US will be at risk when they keep on raising rates. Yeah. I hope that answers that. Sorry, these are very heavy macro stuff. I don't have the data in front of me. Yeah, so I hope that helps. Apologies for it if I doesn't. What commodity ETF do you recommend to take advantage of rising inflation? I don't have the exact, but I think all, like we highlighted last week, I think all would be the bigger, the late cycle commodities. Yeah, because if you take the view that oil price, if you take the view that travel will return, then jet fuel will rise. You take the view that some of the bottlenecks will ease, then diesel will rise because there's more trucking. And there are less lockdowns, then gasoline will also rise because there's more passenger car travel. So anything that's skewed towards all, but sorry, I don't have the ETF. I don't really look at ETF that closely. Yeah, but because some of the ETFs are very heavy on all, some are not. So I'm not very precise. I don't want to give you the wrong answer. But if I had to answer this question, it would be those very heavy on all, because the rationale is that all could take another leap up, because if the lockdowns are start to remove, because demand will surge quite strongly. The unknown is just China, because China's like a black box. They're the biggest. They're, I think 15-20% of all market, but there's a bit of gray matter into how much oil they actually consume. But apart from that, if I had to buy, it would be something that's more oil based. Yeah, I hope that helps. Again, this is outside our area of expertise, so just take it with a pinch of salt, or maybe a bucket of salt. But no, this is just our off the cuff kind of views. If we had to kind of buy any particular commodity ETF. Yeah. But anyway, thanks for the question. Yeah. Okay, with that, I think this comes to the end. Give us some time. We'll try to get someone on to help everyone on the technical analysis question. Once we get it on, we'll definitely let everyone know in our chat group. Yeah, so sorry if the next maybe 1 or 2 weeks, we won't have anyone to help anyone on your technical analysis question. So apologies for that, but we will definitely try to get up to speed. Yeah. Nettie, you want to answer this last one on ARA and ESR? Net, if you okay. Yeah, and anyway, on the 2nd and 3rd March, they're going to do a presentation, ARA and ESR, with our remisers. Regardless, we will definitely try to give you an update. They didn't open it to the public, so apologies, some of you may not be able to get there, be able to attend, but it's open mainly for TLs. I think they're going to explain more of the deal. Once we go through that webinar, we will definitely try to brief everyone so that everyone's kind of up to speed, at least what they say. I'm not sure if Nettie can add on to anything. Yeah, okay, maybe Nettie's not there, so sorry. So anyway, I think we'll come to the end, but don't worry, we know whatever webinars we attend, we will always try to give everyone an update. Because most of you may not be able to get access to this, but we get access and we'll definitely try to brief everyone. So with that, I would like to thank everyone for your attendance and also your questions, and apologies, some we can't really answer. So thanks for that, and take care, and have a happy New Year, everyone. Thank you.